fundsupermart.com.
Entering 2015, global central banks have adopted diverging monetary policies. Dr. Joseph Davis, Principal, Chief Economist and Head of Vanguard Investment Strategy Group, shares with us his views today. What is your view on global monetary policies? What impact will central bank divergence have on investors?
Well, I think we're already seeing the impact on investors around divergence. I mean, a clear increase in volatility, the strength of the U.S. dollar, and I think expectations are that that will continue. For the ECB, we were obviously anticipating actually for several years that they would ultimately pursue quantitative easing because of the deflationary pressures. And so the balance sheets of the ECB and the Bank of Japan will continue to increase over the next 2 years, and we actually may see more. I think the implications for the U.S. Federal Reserve, which clearly have tapered in the end of quantitative easing, are that the risks are that the Federal Reserve will not be as aggressive in them starting to raise rates as perhaps they would have been given the heretofore strength in the U.S. dollar. So I think that's something that people aren't necessarily talking fully about, but over the next several months we may hear more about.
How do you see falling oil price affect the global economy in the next 12 months?
Well, I think it's a great question. I think to answer that question appropriately, one has to diagnose why oil prices are falling. So for example, is it really related to weak demand or is it to excess supply? By our calculations, roughly 25 to 30% of the drop in oil prices has been related to weakening demand, not just in China, but in other markets. But that leaves 70% to strengthen the dollar and to some excess supply considerations. So why that is if it's supply related, it's actually somewhat positive for growth, clearly for the four major economies of the world, for Europe broadly, for the United States, for Japan, and then for China. So that's net that's positive. I mean, there's ultimately more energy consumers in the world than producers of it. But the rapid rise, I think we should expect some reasonable dislocations in certain emerging markets and certain energy producers throughout the course of this year.
With Swiss franc scraping its currency cap, what is the impact on the Eurozone?
Switzerland's impact on the Eurozone, I think ultimately will be somewhat modest. I mean, it was clearly a surprise what the S&P did in terms of allowing, just letting go of the peg to begin with. I was surprised they didn't perhaps just reset the peg at a higher level. But I think what this could represent more broadly actually is something where the central banks being less of a source of volatility dampening and perhaps in this divergent world, more of a source of volatility at the margin going forward. I don't necessarily think actually that's all a bad thing, but I think there's actually more in store of this. And in fact, I would anticipate greater, for certain economies, that if their currency is pegged, in the next year or two to actually see more pressure on certain pegged currencies, much like we saw with Switzerland.
What is your view on deflation in the Eurozone? How will the weakening euro impact the region's economy? What are the investment implications?
Sure. Well, I mean, we've been of the mind, not just in Europe, but globally, that for several years, that deflation was a much greater risk than inflation. Clearly that's become more accepted, but I think these deflationary forces will continue to persist for some time. And it's not necessarily related to just oil prices and commodity prices. It's the fact that in many economies they're growing below a lower trend world, growing below their already lower trend. In fact, the United States is probably the only exception of the major economies that's growing above their sort of lower trend growth pace of 2%, growing to 3%. So in Europe's case, I think it's important for Europeans to believe that deflation will not take a permanent hold on their economy, much like happened for a time in Japan. That was a battle that the U.S. Federal Reserve generally was successful at. Japan only recently has gotten positive inflation expectations. So I think the ECB's efforts are trying to make sure that deflationary expectations do not become ingrained or entrenched in Europe. So that I think is the primary positive benefit the ECB will have to focus on with their quantitative easing program.
There have been recurring concerns around China's slowdown. How do you see the growth in China in the next year or so?
We've clearly, as a global team, been of the mind that the risks are modestly towards the downside in terms of Chinese growth. If the target or loose expectation has been, in the mid 7% range. That perhaps our leading indicator is slightly lower than that. I think recent high frequency statistics are consistent with that. I think though taking a longer term view like we do at Vanguard, we actually view lower trend growth in China is not necessarily negative. It's actually consistent with economies that develop and become richer over time without exception in world history, and also I think consistent with some of the well-intended structural reforms that are ongoing. So I think the world has to deal with some cyclical weakness in China potentially next year or two, but I think longer term for global citizens this is actually a very positive development if China continues to make progress on those structural reforms.